Hello traders, welcome back. Today we're zeroing in on something you can't afford to miss. Effective swing trading strategies that work across all markets. Here's what we'll cover in a nutshell. Stuck in a box. Perfect for range-bound markets. This strategy aims for consistent, methodical gains. Catch the wave. For those who love following trends, learn how to identify and ride them profitably. Fit the move. A more advanced technique for spotting and acting on potential market reversals. Before we jump into the strategies, let's first understand the foundation of what we're discussing today. Swing trading. What is swing trading? Let's break it down. Swing trading is a type of trading aimed at capturing short to medium-term gains in a stock or any financial instrument over a period of a few days to several weeks. Swing traders primarily use technical analysis due to the short-term nature of the trades, but they may also use fundamental analysis or a combination of both to make their trading decisions. Why is understanding swing trading important? Well, it's simple. Swing trading allows traders to take advantage of market swings or waves. By understanding the rhythm of the market, swing traders can enter and exit trades at the most opportune times. Take a look at this chart here. You can see the market moving in a range. It goes up to hit a high point, then down to a low, and back up again. These peaks and troughs are what we call swings. And it's not just in range-bound markets where you can swing trade. Here's an example of a trending market. Notice how each upward trend is followed by a minor pullback before the next leg up. These are your swing opportunities in a trend. Understanding these patterns is crucial because it helps you predict potential market movements and make better informed decisions about when to buy and sell. It's about timing, and good timing can significantly enhance your trading results. Now let's dive into our first strategy, affectionately known as stuck in a box. It's a fantastic strategy for those just starting out and also serves as a reliable technique for seasoned traders. Stuck in a box thrives in range-bound markets. These are markets where prices oscillate between two horizontal levels. These levels are what we call support and resistance. First, let's identify what support and resistance levels are. Support is the price level at which demand is thought to be strong enough to prevent the price from declining further. Think of it as the floor of your trading box. Resistance, on the other hand, acts as the ceiling. Here, selling pressure is sufficient to prevent the price from rising higher. Let's apply this to our stuck-in-a-box strategy. You'll want to watch the market as it approaches these key levels. An optimal entry point is just as the price bounces off the support. This is where you go long. And as for when to exit, you should plan to sell just before the price reaches the resistance level. Exiting before resistance minimizes risks, as the price may start to descend as other traders begin taking profits. Here, let me show you an example. Look at this chart. Notice how the price touches the support, then moves upward towards resistance. Entering at support and exiting just before resistance would have secured a profitable trade. It's important to note the indicators and patterns that can help confirm these movements. Candlestick patterns, volume analysis, and technical indicators like the RSI or stochastic oscillator can provide additional confirmation to enter or exit trades. Perfecting this strategy can really enhance your trading toolkit. Now, ready to catch some bigger waves? Let's move on to our next strategy, which deals with trending markets. Catch the wave. This approach is tailor-made for trending markets, where the goal is to harness the power of significant market moves. Catching the wave means identifying strong trends and using them to your advantage. A key tool for this strategy is the 50-period exponential moving average, or EMA. This indicator helps smooth out price data over a specified period and highlights potential entry points within a trend. Here's how you use it. When the market is trending, the 50 EMA can act as a dynamic support or resistance level. In an uptrend, for example, the EMA provides support. Prices often pull back to the EMA before resuming the upward trend, which is where you want to enter. Look for bullish rejection patterns as your signal to enter. These could be candlestick patterns like a bullish engulfing, hammer, or a pin bar forming near the EMA. These patterns indicate that despite the pullback, the buying pressure remains strong, signaling a good time to jump in. Now, deciding when to exit is crucial. You want to exit your trades in alignment with the trend, but before the momentum fades. A practical approach is to set your exit point near a previous swing high in an uptrend. Let's analyze this chart together. As you can see here, the market started trending up. Now take a look at this first dip. the price comes down to touch the 50 exponential moving average, or EMA, and we've got an inside bar pattern forming. That's our first hint at a possible upward move. Following that, the price rises, and what do we have here? Another dip down to the 50 EMA, but this time there's a pin bar pattern emerging. Notice the small body and long wick at the bottom? This pin bar is like a springboard, pushing the price back up. And here's the third time, the price dips again, touches the 50 EMA, and gives us a tailed bar with a significant rejection. See that tail? It's like the market is saying, nope, we're not going down, signaling another move upwards. Utilizing this strategy not only aligns you with the market's direction, but also allows for systematic trade management. By riding the wave of the trend, you maximize gains from the market's natural ebb and flow. Catching waves can be thrilling, but what about when the market shows signs of a potential reversal? That leads us to our next strategy, which is a bit more adventurous. Stay tuned as we dive into Fit the Move. Fit the Move is about identifying when a trend might be overstretching and preparing to reverse. This strategy is not for the faint-hearted, as it involves going against the prevailing market direction, a tactic that can be highly profitable but also riskier. The first step is to identify market overextensions. These are points where the price has moved sharply in one direction and is potentially overbought or oversold. Technical indicators like RSI or the stochastic can be invaluable here, signaling when conditions are right for reversal. In an uptrend, there are some powerful patterns we keep an eye out for right at resistance levels. Those are the ceilings where the price has a hard time breaking through. Patterns like engulfing bars, pin bars, inside bars, and dojis can be telltale signs that sellers are starting to outweigh the buyers, hinting at a possible shift downward. When you see any of these patterns forming at resistance, that's your signal. It might be time to think about taking a short position, betting that the price could drop. But here's the kicker, always set a proper stop loss. You're looking to hop on a possible downtrend, but if that ride doesn't take off like you thought it would, your stop loss is your safety net. It's there to catch you, ensuring you only risk a little to potentially make a lot. Take a moment and look at this chart with me. Notice the bearish engulfing candle right at the resistance. This type of candle, where the current one fully swallows the one before it, can be a strong signal that the market could be shifting gears. And if you glance at the RSI indicator, it's showing overbought conditions, another hint that the uptrend might be running out of steam. So deciding to enter a trade at this point, you'd want to set your stop loss just a bit above the high of that engulfing candle. This strategy is about smart defense, protecting your trade against any sudden moves in the opposite direction, those false alarms that can happen in a lively market. Your exit strategy should be just as calculated. Aim to exit at a prior support level or another significant reversal point. This approach helps manage the risk while aiming for a reasonable profit from the predicted downward swing. Counter-trend trading like Fit the Move requires careful trade management and a clear understanding of market signals. While the risks are higher, the potential rewards can be substantial if executed with precision and caution. Now that we've covered Stuck in a Box, Catch the Wave, and Fit the Move, I'm eager to hear from you. Which of these strategies resonates most with your trading style? Are you more comfortable riding the trends, playing it safe in the ranges, or do you thrive on the challenge of counter-trend moves? Drop your favorite strategy in the comments below and let me know why you prefer it. And if you found this video helpful, don't forget to hit the like button and subscribe for more insightful trading strategies. Your support helps us bring more great content your way. Thank you for watching, and until next time, keep your trades smart and your profits high.